What's up, guys? Welcome back to the channel. Let's dive straight into our trading tutorial for today, which involves exploring a strategy I call the last gasps of demand. In this particular trading strategy, the price moves to or passes key support levels. The signs that the supply is in full control become more evident when there is a distinct break in market structure or a drop below the halfway point of the trading range. Another crucial element of this strategy is a market's tendency to test real supply zones. In our case, is this particular one over here. This test, which often precedes a market dump, would lead to the balancing of the imbalance area within the supply zone. By effectively interpreting this smart money liquidity grabbing technique, we as traders can actually anticipate market shifts, determine our point of interest, and accordingly make high probability or calculated entries. So without further ado, let's get started with the chart. The first detail I'd like to draw your attention towards is this strong impulsive movement, which is responsible for forming both a supply zone and an area of imbalance. Navigating further down, we observe the price ranging and establishing a mini base before it proceeds with its downward trajectory. This subsequent limited upward shift, totally, in my view, manipulative in nature when considering the proximity of these imbalance zones. And guys, you have to remember here, as per Wyckoff, price moves from balance to balance. So this limited retracement serves, in my opinion, as a strong indicator of the market's bearish inclination. Following this, the price undergoes another downward leg. Now, the reason I'm going through these price movements is to help you guys understand what the principles of supply and demand are telling us when analyzing a trading range, meaning that by evaluating the force of accumulation or distribution and reactions within a trading range in terms of spread, speed, and volume, we can actually gather important clues about the likely direction or bias of the market. So after this last balancing move down here, the market makes a swift turn, initiating a bullish trend. The market, and as you can see from the chart, retraces its steps before it finally probes the supply zone and reestablishes equilibrium of this imbalanced area. At the same time, though, and this is an important detail that we need to point out, price fails to reach equal highs, let alone print higher highs. This way indicating that this supply area is now our point of interest. So following the printing of the price inside the supply zone, the next crucial element to understand in the last gasps of demand strategy is to recognize indicators that suggest bears are in control. This dominance of the supply side obviously becomes even more apparent when there is a clear break in the market structure. In our chart example, the supply that came to market to hold this demand wave signaled by a distinct break in market formation, and I say distinct here because of the way how the market sharply declines after testing the supply zone. So this influx of supply that led to a clear break in market structure marked, in my view, the onset of the last gasps of demand setup. And now, after the nosedive, notice how the price surges from this specific point. Yet, despite multiple attempts, it fails to break through this resistance line. The price's inability, I think, at this point to surpass this resistance area, which obviously represents a structural level, signals further market weakness. Moreover, it offers us an opportunity to enter a short position once the price is drawn to or finds equilibrium within the imbalance zone. Generally, the upper or lower part of an imbalance area aligns closely with a demand gasp. Essentially, a demand gasp is a region where large market players begin to unload shares in quantity, obviously, following a noticeable upward move. The beauty of the last gasps of demand strategy lies, I think, in its distinct advantage. Unlike other trading strategies, it provides multiple high probability entry points within a specific trading range, as long as market weakness indicators such as change of character in the price action and breaks of market structure continue to surface. And as illustrated by our chart, following our hypothetical entry point, another sign of weakness emerges during this subsequent sell-off, indicated by another break of market structure. This is where we observe the formation of an additional imbalance zone. As the market reverses, artificially adjusting here, we could have clearly capitalized on this balancing attempt in terms of a short entry. A similar pattern is observed with the next leg down. We witness another break of market formation. The price then attempts to reverse through another gasping demand bar, aiming to close the newly formed imbalance zone before it actually starts plummeting. So we had several distinct demand gasps, entry opportunities, where the strategy's entry points are clearly delineated. And again, within the context of the gasps of demand strategy, you will often stumble upon numerous moderate rallies. These upswings, relatively high impact in nature, offer, I think, solid opportunities to initiate or add to your position. Personally, I prefer not to add, unless, of course, I come across my favorite trading setup, which I explain in detail in this next video. But if you are a trader who enjoys doing so, in other words, adding to your position, then by all means take advantage of the situation, provided that risk management principles are strictly applied to the trade at hand. All right, guys, thanks for watching. See you in the next one.